Hi, gold has been on a tear. Do you have some in your portfolio? I do. Now, which gold stocks do I have? None. I have the GLD ETF. Why not a stock, which I can sleuth? Because the first dirty truth is that very, very few gold producers outperform gold itself. So why bother sleuthing them? Yes, I know. A select few do outperform. Which? And should you sleuth a bunch of them to find out which is best? Nope. You can eliminate the non-sleuth-worthy very fast. Here is how. Assume you want to sleuth a particular gold stock, say Moose Pasture Gold, symbol MOOS. And before you look it up, it's an imaginary stock, just the purpose of education. Your first question should be, is Moose worth the sleuthing effort? You can answer this question very fast before you even put on your gumshoes. And you can answer the question by asking, has Moose already outperformed the price of gold in the past? If it had, it may be worth sleuthing, because it may also do so in the future. But if up to date it hasn't, you'll have to assume that it will change its character drastically and start outperforming in the future in order for you to sleuth it. That's a heroic assumption, and you should be loath to make because your sleuthing time is at a premium. Instead, just buy GLD like I do. But you may ask, how to find out fast if a gold stock, Moose or others, had outperformed gold? That's also easy. Simply chart the ratio of the stock price to gold, say MOOS divided by, let's column, GLD, when GLD is the gold ETF. If the ratio line is going down, it means Moose could not even do better than the commodity it produces. So why bother? Forget about it and just buy GLD. Now, how many gold miners outperformed gold? The dirty secret of gold investing is that very, very few did and do. Just as most stock fund managers cannot outperform the market ETF, the SPY, so most gold stocks cannot outperform gold itself. Why not? Because when you buy the stock of a gold miner, you take on 4 more risks, beside the risk of gold price itself going up or down. First, you get financial risk. Gold miners always need more money, so you'd get diluted or get killed by extra debt if they take it on. Second, you get management risk. They can scam you, dilute you, or just be incompetent. Third, there's political risk, if, say, they are in the Congo or Mexico or in South Africa. But fourth and last, there's production risk. Can they dig gold out cheaply enough to make a profit? That's why so few companies can overcome all this risk and still outperform gold itself. You don't believe me? Let me prove this to you via the ratio chart of some gold stocks. As a payoff to you, I'll finally point out which 3 or 4 gold stocks may have a chance of doing better than gold itself, and so may be worth your sleuthing time. Okay? First, let's look at the price of gold itself, as is seen in its ETF. The first is gold, GLD, an ETF that is 1/10 the price of gold. The second is PHIS, a Canadian ETF allegedly backed by physical gold in the vault of a major bank. Here are the charts, GLD above, PHIS below. Freeze the screen and you can see later on. As you can see, gold itself has done very well, although it did not go up in a straight line. In my opinion, it will also likely continue to do well, with the possibility of getting to $15,000 or $20,000 per ounce in the next decade, maybe by the early 30s, up from $3,400 today. It's just my opinion, of course, and I could of course be wrong. But if I'm right, then gold itself may be worth your attention via the GLD or PHIS. Now, what about gold mining stocks? Can they do even better? Well, before we look at individual miners, let's look at all the ETF of all senior gold stocks, the GDX, divided by the GLD, and by the GDXJ for the junior miners. Look at the top chart for the GDX divided by GLD, and the bottom chart for the GDXJ divided by the GLD. Can you see which direction the charts are pointing? Yep, down, down, down. So first conclusion, if you want to invest in a senior gold mining stock blindly, it will most likely do worse than gold itself. GLD is better than GDX and better than GDXJ. Now, again, if you want to invest in a gold miner, 9 times out of 10, you're better off owning either GLD or PHIS. But you may say, what of individual gold miners? Don't some do outperform the gold itself? Well, Let me show you a few gold miners with the price divided by the gold price so you can see for yourself. And you can, by the way, repeat this exercise with a ratio chart with any gold stock of your choice in your favorite charting program. And as you'll soon see, only 2 or 3 stocks in 50 are worth sleuthing. Yes, all others have done worse than gold itself. So assuming they're going to do better is basically a heroic assumption which I encourage you not to make. Now, let's cut to the chase and look at a few actual gold mining stocks. Here is Barrick, American Barracks, ABXT in Canada or GOLD in the US. That's the one above. As you can see, underperformance all the way. And quite evidently, if you held Barrick lost you an opportunity to benefit from gold rise itself because Barrick did far worse than the GLD consistently. Everything possible, so Barrick can always do better in future, but the likelihood is very, very low. So Barrick is out. What of Anglo Gold? That's the one below it. Divide by the GLD, the price of gold. Again, see the chart. It's down, 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 then level. Ho-hum. Here are a few more stocks just to make my point. Anglo-American, AEM, all senior stocks. Down and sideways. Ho-hum. And the one below, Goldfield, GFI divided by GLD. Down, sideways, and begin to go a little bit uppish. Is it a coincidence? Who knows? Worth sleuthing? Maybe, maybe not. Up to you. A few more. Here is Kinross, KGC, divided by the gold price. As you can see, down and sideways. The one below it, by the way, is a bit different. This is Royal Gold. Royal Gold may be worth looking into, but only maybe. It was up, it was sideways, uppish, and again slightly down. So it's possible, but you decide how you want to allocate your sleuthing time. Now, what about a gold fund, where a pro money manager does the stock picking for you? Let's look at one of the most well-known, the Gabelli Gold Fund, GOLDX in the US. Look at that. As you can see, down, 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 then stable, and again down. In other words, the diversification and the stock picking moxie of the money manager in general do not overcome the fund fees and the basic underperformance of the underlying gold stocks. But you may say, there must be some gold mining stocks that outperform gold itself. Yes, there are, but very, very few. Newmont is not one of them. That's NEM, Newmont Gold. Down, slightly up, and again down. Still, ho-hum. Now, if you look at another stock which is ho-hum, just to kind of drive the point home, look at Anglo Gold, AGI, Alamos Gold, ho-hum. But the one below is certainly not ho-hum. See, the one above, sideways, down, sideways. But the one below is London Gold, LUG-T divided by GLD. That's the first one seemingly worth sleuthing, strongly uppish after a few years of underperformance. Now, just how did this stock do that? How did they manage to outperform the last few years? And will this outperformance continue? These two questions should be uppermost in your mind to find the answer to by physically sleuthing the company. You may find the answer is no, but it's still, to begin with, it's a promising stock to sleuth. And here your time likely will not be wasted. Finally, here is one mildly interesting stock, in my opinion, that Wheaton Precious Metals, WPM, divided by the GLD, its performance against gold, the line is rising slightly, so it does better than gold over the long term and even pays a dividend. Now, finally, the most interesting stock, in my opinion, after London is Franco-Nevada, FNV divided by the GLD. It's the one below. As you can see, for quite a number of years, Franco-Nevada, which is a royalty payment company, had been flying well above gold price for several years. Then in 2 years funk, where it did worse than gold. Why did it do that? How come? And can it improve what has gone wrong? Again, to see why, you'll have to sleuth it. But the answer to above two questions may pay you more than sleuthing any of the companies whose outperformance of the last few years have been negative. In sum, if you want to invest in a gold stock for the long term, first check if the stock has outperformed the metal up to now. If it hasn't, stay away and stick to gold ETF, either GLD or PHIS. The only ones worth considering are, in my opinion, Franco-Nevada, FNV, Wheaton, WPM, London Gold, LUGT, and maybe Goldfield, GFI. No GLDX, no GDXI, no American Gold Fund. It's just my opinion, of course, and not an advice. It would, of course, be wrong. So sleuth it out, look at the charts, and decide for yourself. That's all for now. Please let me know in the comment below what you think of the above. Give it a like, subscribe to the channel, then forward to all your friends and subscribers that they subscribe to, and buy my books, The Sleuth Investor, The Advanced Sleuth Investor, where you can learn how to do what the lazy investors never do. That is, sleuth physically for proprietary information for worthy stocks. And if you like the books, please do review for them on Amazon, which are hopefully good ones. I'll see you next time, and meantime, thank you very much for watching.